Joining me now is the NYU Stern School of Business professor. We call him the Dean of Valuation, Aswath Damodaran. Welcome back. It's nice to see you.
Nice to see you too, Scott.
So I know you don't own these stocks, and you probably don't even follow them for that matter. But is there a cautionary tale in here somewhere on a market that has anointed certain types of stocks as the kings and given them huge valuations, and there may not be a lot of there, at least in the very near term? What do we take from this?
I think we've known for a while that these products and services, whether it's in quantum computing or in AI products and services, that they're not going to be here next year, 2 years from now, even 3 years from now, that there's going to be a timing lag. I keep trying to wrap my head around why it's become such a big story. And the only thing I can think of is Jensen Huang and Mark Zuckerberg have made it the story it is. Because until they got up and said what lots of people have been saying, it's almost like the traders were not willing to listen. So I wouldn't be surprised if this wasn't the first of a wave of these things you see this year where somebody with credibility gets up there and says, guys, we're getting way ahead of the game here. This is not going to happen in the near future. You're going to value the companies based on that premise.
I mean, you can have bubbles in certain pockets, small pockets of the market, without having a bubble in the entire market. I mean, we've discussed that many times. Is that what you would look at in a case like this, that it can be a self-correcting mechanism as well that doesn't necessarily need to upset the whole story?
And these are not really companies in the traditional sense. They're really options on products. And collectively, if you look at the market cap of these companies, even before the correction, it's small. I mean, it's petty cash for many of the big tech companies. My guess is the best end game for many of these companies, they get acquired by one of the big tech companies. So if you're going to be trading in this space, I think you're trading for who's going to get acquired by whom rather than what will these companies become as steady state companies. Because there's really no business right now that you can point to at any of these companies.
I mean, they're a speculator's delight. I mean, that's what
Absolutely.
Ultimately it comes down to. Let's get to the here and now companies, the ones that we know are delivering and we think are going to continue to do so. I mean, when you look at what's going on within mega cap tech, you can talk about NVIDIA directly if you'd like to. I mean, what do you see after a group of stocks sort of ran out of gas, got reignited, we had a top-heavy market, and now seem to be in question, at least in the near term, because of the move partly in interest rates?
We're seeing what happens when the Mag 7 pulled back in the last 6 weeks in the market. Without those stocks pulling the market ahead, you're going to come back to earth. And that's, again, not a bad thing. But back-to-back 20% plus years for the S&P 500, first time since the late 1990s. Doesn't mean that this year has to be a bad year, but it's time, I think, to take a break and say, hey, you know what? Getting a 9% return on stocks is not a bad return. But I think people's expectations have been set so high based on what's happened in the last couple of years that might be time for a correction.
But don't you think the environment is still pretty positive for stocks? If I told you just baseline, you know, the economy's at a good place, and now we're going to re-up some tax cuts, and we're going to have deregulation, and we're going to enable more deals, and that in and of itself is going to be a stimulant for stocks.
You could argue that much of that has already been priced in. It's almost like the market started expecting a Trump win middle of last year. I mean, got there well ahead of the pollsters and the experts, and I think it started building it in. The tax cut itself, I would not put too much weight on it because I don't see it as a collective tax cut like it was last time. This is going to be more selective, the 21% down to 15 or whatever it turns out to be. So I think if there's a gain here, it's going to be in sectors that are particularly heavily taxed or sectors where regulation is a challenge. So it's rather than market-wide, it might be in smaller sectors, but those sectors don't have the market cap to carry the entire market. So you got to still keep hoping that big tech doesn't give up too much of its gains, because if it does, it's going to be too difficult to make it back up.
I mean, when you look at the move in rates as the Dean of Valuation, as we refer to you as, do you say that, where I thought maybe the market was sort of pushing the limits on the multiple is now going to be pressured even further? Because how can you not have a pressured multiple in a different interest rate environment?
No, I think it really depends on, first, whether rates continue to go up and why they go up. If they go up because the economy is stronger, I think the market can sustain it. They go up because inflation is increasing. I think the market's going to have a really tough time dealing with that. So not only should we keep our eye on what rates do, but we should also be keeping our eye on what inflation does, because it's that dual effect that's really going to play out in markets.
I mean, do you think it's going to be more of the former than the latter?
I think it's going to be more of the former, but there's a very real risk of the latter. I mean, I think that you can't rule out the risk that inflation pops back up again, especially if the economy starts to overheat. So I wouldn't put those worries away, because that worry is real, and the market seems to be concerned about it as well.